Hey guys, MJ here again at the Proof of Value podcast. Now, before I go on to introduce our very special guest, remember to hit the subscribe button and the notification bell so that you receive our videos fresh when they are out. Now, at last, guys, we've got the man himself, the person who pays my salary, who has 20 years of investing experience, the CEO of Equity Tracker, Alvin Vong himself. Welcome.
Thanks for having me.
Okay, now let's get right into it. How do you start investing, or rather, why do you start investing, and how do you start investing?
I think the why I started investing was that actually when I was in uni, I was always very curious about business, how businesses run, and generally at a younger age, I was quite well aware of macroeconomics. That's one of the things that I really enjoyed at school, and not so much accounting. And I think what really attracted me to stocks ultimately was this. If I looked around, a lot of how do we actually gain a lot of wealth? If you look at all of the richest guys today, main bulk of their wealth actually tied in with stocks.
So even like you're talking like Bill Gates, Jeff Bezos, all these guys, right?
Yeah, they all made a lot of money through their own business. You're right. And if you think about it, the other way or the common school of thought was that go to school, get good grades, get a great job, climb the corporate ladder. That's the other option that
every year I hope I get a raise and something.
Yeah, exactly right. And when you look at the bottom of it, whether you're a professional, you're a doctor, you're an engineer, you're an accountant, whatever it is, yes, they all have different pay scales, but ultimately you're exchanging time for money. Yeah. Ultimately, it's how skillful you are at exchanging time for money. Yeah. But I wanted to look at a different aspect of how could I actually exchange ideas, right, for profits instead. Right?
That's a lot less work involved.
Yes, there's a lot less work involved, but the barriers to jump through that is also higher, right? I won't say higher, but
totally different skill set.
Totally different skill set, right? And you may or may not need to go to uni to get that skill, but just like any other skill that you want to gain, either become a doctor or engineer, you still need to spend a significant amount of time trying to master it.
Yes.
So that's the why I wanted to get into stocks, right?
Right.
What was the second question?
No, next is how, or maybe you can just explain to me what your experience buying your first stock was like.
Yeah, so my first stock I bought when I was 18, and I can tell you it totally ended up in disaster, right? When I was 18, I was actually first year in uni, and someone told me, check out this stock. I still remember the stock. That stock was, I was actually studying university in Australia, in Perth. And at that time, Australia is very big in terms of mining. So someone told me, why don't you check out this stock? It's at $1, and I thought $1 is cheap versus $10. And I don't know much about it except for the company name. So I went up, set up a broking account. Back then, it wasn't done online yet. It was still, you had to call and make phone calls. And I bought, right, and I left it. So they said the common thought process, you hold it for long-term
investing.
Long-term investing. So I became a long-term investor, and literally $1 became zero.
So it's literally negative 100%.
Yeah, negative 100%. Nothing was left, right? Why? Because the company got delisted eventually, and the company shut its doors.
The shares are worthless, essentially.
The shares are worthless.
So from 18 years old, buying based on hearsay and trust of your friends, to today, 20 years later, now you know his age. 20 years later, right? Obviously, things have changed quite a lot, right? And how would you describe your investment style or philosophy? Just break it down in 3 simple steps.
In terms of investing style, I can say that what has not changed over 20 years is that trying to buy fundamentally good stocks.
Okay, so what's a fundamentally good stock in your view?
A fundamentally good stock, in my view, would be a company's business model has a competitive edge. Year on year, they still make money, right? Second thing is they must be run by decent management, right? And the controlling shareholders are aligned to us as a retail investor, as a small stockholder, right? So that's the sustainability of the business. There is the management, and lastly, we need to look at financials, right?
Financials.
So one of the main key points I always look at in financial is its operating cash flow. Less to do with profit, but more to do with cash flow, because it comes back to your first point: is are they sustainable?
Right. Yeah. So that's very interesting. So these three things, and maybe we go deeper into the first one, which is sustainable. Now, words like sustainable, in my point of view, is it's very corporate speak. I'm not accusing you of using corporate speak, but I understand where you're coming from. But what does sustainable mean? As in the business model, and if it's to do with the business model, how do you determine whether something is sustainable?
Okay, I think so. When you think about sustainability, and here's the thing: now things are getting more disruptive than ever. Why? Because with the advent of the internet and with the advent of technology and the fact that everyone has a mobile phone today, has really changed the landscape for a lot of businesses, right?
Right.
So one of the things that you want to look at is like 20 years from now, what is the need that they serve the customer that is unlikely going to change?
I see.
Right? So if you look at, for example, if you look at what Amazon has done, the need to go and buy, say, groceries, the need to go and buy an item, the need to go and buy something, that has not changed.
Right.
How you do it now has changed.
Offline versus online.
Yeah, online versus offline, right? So the how has changed, right? But what you want to look at when you look at a business, for example, I'll give you an idea. I believe palm oil as a consumption staple in the next 20 years will still be around.
And palm oil is a consumption staple because
like it or not, it is the cheapest edible oil that we have currently today. It's the most efficient one. Yes, it has got its negative sides, which deforestation and so on and so forth, right? Land rights and what. But if you look at the establishment of the industry, it's actually quite well established. Whether you like it or not, today if you're living in KL or in Malaysia, chances are you would consume palm oil either in your own cooking or even in snacks that you buy, or even if you have your teh tarik, that also contains palm oil, right?
So sorry, you're saying something?
Yeah.
So maybe tell me, apart from palm oil, right? I think all of us want to know as well. What are some of the other, maybe just two more industries where 20 years from now it's still going to be here?
I think the semiconductor and electronic sector, it's here to stay, right? One of the major mega trends that we still see today is actually the continuous electrification of vehicles today.
Like cars and lorries and all that.
Cars, lorries, right? Now they talk about driverless, they talk about sensors. So we're actually at the cusp of moving from mechanical to electronics, right? So the electronic sector is definitely here to stay in the next 20 years. Yes, you come out with many different shapes and forms, but the basics of items needs to be produced will not change, in my opinion.
I see.
So I talk about power, and I think if you talk about food in general, any consumer food staples, or even staples like clothing or
I'm quite sure we'll still be eating 20 years from now.
Yeah, we'll still be eating 20 years from now. Even pharmaceuticals, right? Yes, the products themselves will change, but the need for that industry will still be around. Why? Because we will get old. Likely at some point in our lives, we will need some form of medication.
That's very true. And but I have my view is that just because an industry will be around 20 years from now, that does not mean that the stock that I buy in the industry is going to be 20 years from now. Therefore, to your second point about your top three things that describes your philosophy, management is very crucial. Right? Management determines which of the stocks in, let's say, the palm oil industry or the semiconductor industry or the food industry is going to win. Now, how do you tell from inside, from talking to them or whatever, what a good management is?
I think that becomes a very tricky point, especially for a retail investor. First thing, what I always like to do before I buy a stock is actually meet the management. I think there is no shortcut to that. I think for retail investors, the easiest way is to go and attend the AGM. That happens once a year, so don't miss it.
Right.
Alternative, like what we do here is that we get to engage with companies directly. Often I meet the CEOs directly, right? Now during these sessions,
what are some of the questions you ask? You know, what are you trying to gain or trying to gather from these management?
So some of the questions I always ask is, how did you get started? Right? You want to know the history and the background, and you will notice that companies will morph and change over time. Because I want to figure out how long they've been in the business. Right? Assuming it's doing well today, they must have that history and that back knowledge of where it is, rather than a new CEO that's been parachuted in. They may not know the industry as well.
So track record is important to you?
Track record is very key for me. The next questions I always ask them, what is your philosophy of doing business, right? What is, as a shareholder, I have actually largely no control over what you do. But as a business, I want to know what is your philosophy in running this business? Why? What drives you to run this business? Yeah.
And that's important because?
That's important because it really sets the whole forward plan. Because ultimately, when we buy a business,
which is a stock, essentially stock and business,
which is a stock, is the same, right? Yeah, we can look at all the financial numbers. We can look at 10-year cash flow, balance sheet, P&L, but that's all historical. Ultimately, what's going to drive your business to grow and have more value, ultimately, it's going to be dependent on the key person's strategy. So you are buying part balance sheet, part P&L, part cash flow today, but you are effectively buying its strategy going forward.
Are you trying to say that what the management thinks, do, and believes in will ultimately be reflected in these numbers?
Yeah, correct. So the first, so when we talk about strategy, I want to know how long term they are. I want to know where are they trying to head to. What is it they're trying to achieve? The track record. So the risk of buying a strategy is track record, which is execution.
Yes.
Right.
Yes. Can they do it or not?
How do I know whether this guy can do it?
Yeah.
Right. But when I use track record as my baseline for execution, my risk lowers from there. My risk is lower.
Yes.
It makes sense, right? So I will always, my third question is always ask them, so what is your strategy? What is it that, where are you positioning yourself? What do you want to do, right? And here's the thing, right? Whenever you meet CEOs, no one will ever tell you that.
The 100%.
They will never tell you 100%. You got to fill in the blanks yourself. No one will also point out the negative things. So it is your job or my job as an investor to figure out where are the gaps, the possible risks of these plans, right? So they'll always be rosy, right? No CEO will paint an unrosy picture.
I see.
Yeah.
So when you talk to these CEOs and when you ask their strategy, what kind of strategies do you like? Because there's plenty of strategies out there, and what are the things? What are the kind of strategies? What kind of words that they say that really make you a little bit more comfortable?
I like when CEOs think long term enough. That means not to solve the short term problems, but really look long and see what is the effects or what changes they want to take going forward. One of the key points that I always try and figure out is how scalable is their strategy.
I see. Maybe explain to us what do you mean when you say scalable?
As in, they say, look, I want to hit 1 billion revenue, for example. Okay, 1 billion revenue of total market share, if it represents 50%, is quite a long shot.
Yes.
If you say, look, I'm trying to hit 1 billion revenue, but my total market size is 100 billion. I think they have a shot.
Right.
So you need to factor that in because ultimately you're trying to assess how to reduce your risk, right, and whether it's possible. So scale, like, they put some numbers that they want to achieve, right? And I guess when it comes to scale, how are you going to get there, right? If they are ultimately trying to, there's no point scaling up and marginally making less money.
Right.
If that makes sense, right? There's no point going to, for example, if you're doing 100 million in sales this year and you're doing 10 million in profits or cash flow, there's no point going to $1 billion, where if you put it on the same ratio, you should be making $100 million, but you're only making 50.
Which means that there's no scale.
There's no scale. So on an absolute basis, there is growth, but they're actually becoming less and less efficient.
Some of these companies that does not have the scale or the market that you talk of can be quite profitable, right? Do you see them as viable investment options, or you just ignore them and you just go for the?
Actually, I don't. Actually, I do like smaller companies. Why smaller? Because they're easier to analyze, easier to manage, right? And there's a higher probability of success. Smaller ones. And it's okay if they don't want to scale and become the biggest, right? But if they are the best at what they do, and that is the market size,
that's still okay.
That's still okay. The only thing that I need to figure out is, are they selling at a discount today?
Are they cheap?
Are they cheap?
I see.
Yeah,
Okay.
Are they cheap? Yeah.
Speaking of cheap, one way to, from my understanding, is to use financials to determine if something is cheap or not.
Yeah.
So what are your thoughts on financials? What are the things you look for when you get that quarterly statement or the annual report?
I think financials are good, but they are not everything.
Sure.
Yeah. More often than not, purely looking at financials without understanding the industry or the story behind it, actually they're just numbers.
Yes.
They really don't make any sense. Yeah. So one of the things that I do watch out for, like I mentioned before, I always look at the cash flow.
Cash flow, right.
Because I want to know, because ultimately the lifeblood of any company is going to be its cash flow. If it has negative cash flow, then it has to raise more money, right? Which may not necessarily be a bad thing, but it's how it's being raised and what kind of strain does it put on their current existing business.
Right.
Right. So you don't want to be, the common saying is that you don't want to borrow so much, right, that you cannot sleep at night. Yeah,
right.
Okay. So I think because when that happens, when a company gets in too heavy of that situation, then we see that, it takes a lot of management discipline to say,
Yes.
look, we can't plug the hole now, but we need to look longer term.
There's no room for error also, right?
Yeah, there's very little room for error. You're right. So any change in that will actually drop off. What was that question again that you mentioned?
So my question really is, based on your understanding of financials, what are the few things that you look at? So you've mentioned things like cash flow. Anything else that you look at?
I always look at margins, right? I try to avoid looking at quarterly statements.
Right.
Right? Because, I think a lot of investors are too short term. I'm taking this saying from Anthony Robbins. He said a lot of us overestimate what we can do in 1 year, but we underestimate what we can do in 10 years. So if you look at quarterly statements, which are 3 months only, and when investors see a bad quarter, they're like, time to make a decision. I don't think that's a good enough way to actually look at financial statements. Time is a very important factor as well. So it depends on what they're doing. So the whole question you need to ask yourself is this down or up, temporary or permanent? Right? So I look at cash flow, I look at cash flow margins.
Margins, right?
Which is the cash flow over the revenue that they make, right?
How much they make, they sell something for $1, how much do they keep?
Keep, yeah, in terms of cash, right? What are their debt levels currently? Or if it's high, what is, if I look over a period of time, are they reducing their debt levels, for example, right? How much cash they have, how much cash they have vis-a-vis what is their debt level.
I see. So obviously you want their cash flow, let's say, or cash to be higher than what they've borrowed. for obvious reasons, right? The more cash flow they generate, then the debt doesn't seem like a problem.
Yeah, correct. And of course, revenue. I mean, everyone looks at revenue, but
Still,
that's not. I mean, it's an important factor, but it's more important to look at these numbers over as a whole rather than only picking one number.
So if I can summarize your entire philosophy, really, number one is that it must be in an industry that has a very long-term outlook. You know, 20 years, maybe even 30 years from now, it's still going to be around. Number two is that you need to have management that understands the business well enough, and that they have the right strategy so that they can be the one that steers that specific company that you're buying to take advantage of this long-term industry, long-term booming industry.
Correct.
And last, of course, you need to make sure that the financials are in order in terms of the cash flow, the debt, and the margins.
Yes, correct.
Okay, fantastic. Now, that's what you would do before deciding to buy a stock. Now, of course, you've had 20 years of experience. Very few people have that amount of experience in the market. What are, let's call it, the top 5 things, based on your experience, that you will never do, and that I shouldn't do, and that everyone watching this or listening to this shouldn't do?
Top 5.
Just 5.
I think one of the biggest shortcomings we have as human beings trying to become better investors is that every time we make a purchase or a sale, not necessarily a stock, right? It could be, when was the last time you made a purchase? There will always be an element of emotion that tips you to make that decision. However, when it comes to stocks, you need to work the exact opposite. You got to be as emotionless, as pragmatic, as objective as you can be.
Emotionless, pragmatic, objective, okay?
Yeah, as objective as you can be. So one of the things that I would tell you not to do, right? Never wait in front of your screen for the market to open, and avoid trading the first half an hour or the last half an hour.
Because you want to avoid the emotions.
Correct.
Because when you see the numbers go up and down.
Yeah, it will trigger an emotion, right? If it comes down, it's going to trigger you to cut your losses or sell it. If it goes up, it might push you emotionally to actually buy some more. So you don't want to miss out, right? So FOMO, right? So fear of missing out. So that is something that I used to do. I will tell everyone that I know today, please don't do that.
Unless you're a day trader.
Well, of course, yeah, unless you're a day trader. But if you're an investor, if you're a long-term investor, your day-to-day prices shouldn't really matter that much.
I see. Okay, don't look at the screen in the morning or when the sun is still out.
Yeah.
So next.
The second one that I'll tell you guys not to do is that don't put money in stocks that you need in the next 6 months or 12 months.
Okay, because?
Right. Why? Because you must look at investing as a long term, right? So I always tell people, when you guys buy property, most people say, look, how long are you willing to hold it for? 5 years. And you think that's okay. But when it comes to stocks, when I ask a lot of people, they say, how long do you hold your stocks for? I said, I'm willing to put money in stocks with 5 years that I know I don't need that money in the next 5 years. They're like, wow, that's so long. Right? But it's the same concept. So why? Because markets move up and down. So I like property. You're not going to get a property price every day. Unfortunately, prices you get every single day.
Yeah. No one's outside your house saying today it's 1 million, today it's 900,000.
Yeah, correct. And because you have that, you get tempted to buy and sell. So one of the things that I will tell people not to do, or the listeners not to do, is actually put money in the stock market for money that you don't need. Don't even put money that you need for a rainy day in there, because I can tell you from my personal experience, it's when you need money is when the stock market will always be at the lowest.
Yeah, where it's time to buy.
When it's time to buy. When you don't need money, it's normally when the stock market's at the highest. Right. That's a personal antidote, right? So put money in stocks that you actually don't need and you cannot touch for at least 5 years.
Will you say also it helps with that emotionless part as well? because you don't need to take that money out to use for personal.
I think I think it helps, but it comes back to personal discipline, right? It's one way to manage your emotions, but I can tell you, even if you say you're gonna put money there for 5 years,
Got legs on.
It's a got legs. Some people still decide to buy and sell, and do that emotional thing. So
Right.
so that's something that I would tell investors definitely not to do. Right?
Okay.
Don't put money in there that you don't need. Now, what I say is not to say don't trade, but I'm saying that put money in there as in, I'm not asking you to buy and hold a stock for 5 years, don't get me wrong. But what I'm trying to say, put money in there and run it as a portfolio.
There's a collection of stocks,
Yeah.
like almost like a business, right? When you invest in a cafe,
Yeah.
you don't think that you can sell it for the next 5 months and get an 80% profit.
Correct. That's the whole. So reduce that short-term thinking. I think the third thing that I'm gonna tell you guys not to do, don't listen to stock tips, right?
Even from good friends.
Even from good friends, even from me, don't listen to me, right? In terms of stock tips, don't do that. You need to be 100% behind the reason why you're buying this stock, right? Now, is there a chance that you'll be wrong? Absolutely. But is there also a chance that you'll be right? Absolutely, right? But what I see a lot of people do is that they not only take the stock tip, but they actually go all in on that one stock. And my third advice is don't just listen to rumors, and then a lot of times people tell you what to buy. They will never tell you what to sell or when to sell. They also won't tell you how much to buy.
So that's your fourth point, right?
Yeah, so the fourth point is that you need to look at the amount that you're buying. So if you can, don't take stock tips, right? In terms of if you think it's a good stock and you do say you can help yourself, but you want to take up on the stock tip, limit your capital, which is what I'm trying to say is build a portfolio of stocks, not just buy one stock hoping that it's going to go up.
So if you get it wrong, it's a small loss.
Correct. So if you put in say 5% or 10% of your money into one stock, no matter how sexy it sounds, say if you lose half, you only lose, if it's on 5%, you only lose 2.5% of your total
2.5%.
portfolio. Right?
So 100,000, you lose 2,500.
Yeah, correct. So that's a very basic sort of advice that I can tell the listeners today is that don't just buy one stock and hope that it will go up. You need to build a portfolio of stocks.
So before we end, last one, things that you shouldn't do. Number 5.
The last thing to do with stocks is that never stop educating yourself. Yeah. Why do I say that? I see a lot of people say, you know what, there's a lot of free stuff out there, why don't I go and learn it out first? Or why don't I try it out in the stock market before I start, before I actually let me make enough money that I start learning, right? But here's the funny thing, we tend to do funny things like this in the stock market, but in real life we will never do it. Like, would you trust a pilot if he said, look, I'm gonna just fly first, earn an income as a pilot, and then I'll figure out.
I'm going to learn through experience.
I'm going to learn through experience.
Few crashes, doesn't matter.
Crash a few planes,
Yeah.
and then I'm going to save up enough so that I can start learning of actually how to become a pilot.
Yeah.
Now you won't, so it doesn't make logical sense, right? It won't make sense for a pilot, neither will it make sense for a doctor. Neither will it make sense for an engineer,
Yeah.
neither will it make sense for an
Absolutely.
accountant.
I want my buildings to be right the first time.
Yeah. But the funny thing is, we all have this perception that it only applies for everything else except stocks. Stocks is something that, that's so easy. I just go and buy and sell, I'll figure it out, I'll earn enough money, then I'll go and educate myself. Unfortunately, that is putting the horse, the cart before the horse. Right? So those are the 5 things I'll tell listeners, please don't do it. You got to think of it properly, think of it objectively. There's no argument to that.
Yeah.
Yeah.
All right. That has been a fantastic half an hour filled with insights. If you want more insights or if you want to ask Alvin more questions, leave a comment below, right? When we get our questions, we'll pop it to him and we'll reply straight away. See you at the next podcast.